For the last year and a half, we talked about mortgage rates being driven by inflation. There is no report that has caused more volatility across the bond market and rates than CPI, Consumer Price Index, definitely the market's favorite inflation metric. Now, this month's CPI was especially important considering that last month showed a massive reduction across both core and headline numbers. Now, Thursday's CPI did come in at forecast across month over month and 1/10 lower than year over year core headlines. So, definitely a solid report showing consistency and inflation trending lower. A nice positive initial reaction, and then a couple hours later, we saw 180. Massive sell-off across bonds, and mortgage rates worsened by the end of the day, which did bleed into Friday's producer price index, came in 1/10 higher than forecast. Now, it's at the producer level, so a little farther down the supply chain, but still an important inflationary gauge for the market. So we did see rates worsen on Friday to close out the week. So why is this? Why if CPI is showing inflation trending lower, we see this negative reaction across rates? Could it be that the second half of July we saw oil prices rise and there was concern across the markets this might bleed into some of the inflation numbers in September and October? Could it be that other economic sectors are still showing strength, resilience, and this might force the Fed to hold their federal funds rate for higher and longer than what the markets are forecasting? I mean, if you look at the Fed futures forecast, they have 4 to 5 rate cuts built in for 2024, which in my opinion is crazy. Now, it's all going to come down to incoming economic data. And this week brings us retail sales, the measure of consumer spending and demand. This comes in lower than forecast. It should show the Fed that their measures, their rate cuts up to this point are working to slow the economy and getting inflation to trend closer to its 2% target. If you have any questions about these headlines, about these changes in rate trends, or if you want to know how they impact you and your purchase power, definitely give me a call. This is Billy.Saylor, your mortgage professor, 571-330-5884. Have a great week.